We use the Heritage Foundation's Index of Economic Freedom. They've been running for about 15 years, and they rate every single country, all 250 some odd of them, they rate every single country on a scale of 0 to 100 in terms of economic freedom. And what they've found is countries with more economic freedom have larger gross domestic product growth, and therefore they have better stock market returns. So you can add that last piece on. Better stock market returns means they offer a better opportunity for investing. So one way to look at it is you can either put your corn seed in fertile soil, or you can put it on the sidewalk where it gets trampled on. And the trampling on is the lack of economic freedom. But if you put it in fertile soil, it's going to have a much better return. So we're going to look at the countries with the more economic freedom, and we're going to see whether or not they have actually performed better over the past years. We've been doing this study for several years, and every single year it looks like countries with more economic freedom offer a market rate of return of growth on their stocks of at least 4 to 5% over the EFI index, and the EFI foreign index has been beating the United States. So you'll get 2 boosts in terms of the return by overweighting countries with more economic freedom. So here is the top 11 countries in terms of economic freedom. You'll see it's Hong Kong, Singapore, Australia, New Zealand, Switzerland, Canada, Ireland, Denmark, the United States, and then Chile is last at number 11. And these are the countries that we think you should invest in, and this is a sampling of those countries. It's most of them because it's most of the ones that have large investable assets, large investable markets, and also have low debt and deficit. Now, the United States is one of the countries in there. It's currently ranked number 9, and it has high debt and deficit. So that's why I've put it in a different color. It's not only is it the United States, but it's also has high debt and deficit, and we don't necessarily recommend the United States as one to overweight. So we underweight the United States, we overweight other countries in this. But we're just going to be looking at the foreign stocks, so we're just going to be looking at how to allocate some of the other countries.